It's the morning drive.
Good morning, and welcome to the Morning Drive. I'm your host, Brooks Fiesinger of BrooksFiesinger.com and MillionaireWho.com, where we help you stabilize your wallet, secure your future, and succeed in entrepreneurship finance. I'm here with a special guest today, Bill Kaufman. You might notice I've lost my voice, and Bill even suggested to me earlier, he's like, should we reschedule this? I said, no, we'll do it. People understand, right? Because it happens sometimes, and you got to roll with the punches. And one of the annoying things I keep talking about is you just got to do it. There's always stupid excuses for you not to do what you need to do, and I'm not going to let my loss of a voice keep me from getting this podcast across to you so you can hear from this awesome guy next to me right now, Bill Kaufman. So, why do I have Bill Kaufman here? We're starting to talk about this idea of finance and stocks and investing. And, I said it before, but nobody can be an expert at everything. There's a lot of things I'm good at, and I'm good at investing. I'm good at saying, but I'm not going to be an expert in everything. So I need to pull people in like this guy who really is an expert in the world of investing and finance and stocks. And he manages some investments for a large, massive corporations, one of the biggest ones in the city. And he also manages his own finances very well. And he's always got fantastic ideas, and he's always doing amazing things. And he's definitely somebody you need to hear from, because I can introduce you to somebody who is just getting on the road, like many of you are, and then I can talk to somebody who's way down the road and is already doing it. So you can learn from those who are experienced, those who are already making it happen, so you can make it happen too. So if you don't mind me getting started, Bill,
sure.
I'd love the listeners to hear. What is your history? What is your background? How did you get to where you are today?
Well, I would say it started when I was, 12 years old, and the stock report would come on at lunch every day, and my parents would be eating lunch, watching TV, and the stock report would come on, and I was just drawn to it. My parents did not invest. They did not know what the stock market was, so they never really talked about it. But I was drawn to it, and so by the time I got to college, I became more interested in it. When I decided to go back at the age of, at the age of 24, I decided to throw some money into the stock market, because I thought everybody at the time, it was 1999 to 2000 in that time frame, and I thought everybody's making money, so I can do this. So I started investing, and after I lost, my first $10,000 I threw into the market, I thought, I've got to learn something about the market, not just throw money in and gamble. So, by the time of 25, that's when I really reset everything. And I said, I'm going to, I started at my MBA. I took finance classes. I started reading everything I could get my hands on. And so I set all these goals for me. And 17 years later, here I am.
So, I know he probably doesn't want me to point it out, but he looks like he's like 20, okay? He's not 20. He's much older. I said he started when he was 24, and that was 17 years ago. So you can do the math. He is experienced. He has been doing this. Don't let the pretty face fool you. He does have some experience here. So one of the first things you ever told me is you said, that you didn't really like mutual funds, because you said, why would I pick a football team when I can build my own fantasy football team, right? Which would you do? Would you rather pick all the best players for a team, or do you want to pick a team that's already out there? And so I think that's a great answer to the question. Can you tell me and the listeners, what is your philosophy? What is your investment philosophy?
So a lot of people, you will hear everyone says, go buy an index fund, go buy a mutual fund, you need to invest. Well, their mode of investing is really trying to place a chip on every company and really bet that way. So as long as on average more than 50% of the companies do well, you should do okay. My philosophy is I'd rather get out my knife and carve a little more delicate and look at the individual companies and try to figure out, okay, why would I want to own this one? Because if you own an index fund, for example, the S&P 500, you own all 500 companies in there. But that doesn't mean all 500 companies are good. So why would you invest in an index fund when you can pick and choose the best companies to invest in? And that's my philosophy. I really look at it saying, I want to find only the best ones, only invest in those. And the football analogy, yeah, I love that one. I always tell everyone, it's like, why pick one team out of the Big Ten? Or a mutual fund really is investing in the Big Ten. All the teams, you get to play them all. I'd rather say, no, I think this team is going to be the best for these reasons. And even if that team isn't the best, more than likely they will be near the top. But I'd rather have that approach and not be the absolute pick the best team than to pick all the teams, because some of those teams in that conference are going to be bad. So that's pretty much my philosophy.
And so why do you choose, stocks seem to be your preferred investment mechanism, right?
Yes.
So why do you choose stocks instead of all the other investment options?
Stocks are the easiest. When I say easiest, so some people love real estate. They will go and they will own a rental property, but you have to go find tenants. You have to make sure that they're not trashing the house. You have to collect rent every month. You have physical work you have to do. When I buy a stock, I really view it as I am part owner of this company now. So, and everyone at that company is working for me, but I don't have daily interaction with those people. So if I own a company like Apple, I could say, well, I have a stake and a claim of a company that is so big and makes so much money, and I don't have to do any work. So I look at those companies like that, and that's why I like stocks, because I have to do some research. Don't get me wrong. I do research to make sure that I'm picking the best companies. But once I own those stocks, it's pretty much I sit back and I let the dividends roll in. The capital gains are going to come in, and I don't have to do much more. I don't have to manage on a day-to-day or month-to-month expectation, other than making sure the company is still solid footing. But generally, you can do that checkup every 3 to 6 months, and you're just good.
So you mentioned you have to do a little bit of work, and you got to do a little bit of research. What are you looking for? What is your strategy?
When I'm looking at companies and I'm trying to figure out which ones I want to buy, the best thing I want to do is really look at their cash flow statement. You can say income statements, balance sheets, cash flows, they're kind of confusing. Income statements are nothing more than the money they're making. Balance sheets are what they own, what they have. But cash flow is where it really shows you, throw all the accounting stuff out the window. Cash is king. So the money that's coming in that they get to keep at the end of the day is what you're going to see in your cash flow statement. So I can look at that and go, wow, they're making, X amount of dollars, and divided by number of shares outstanding, that can get me to, let's say a company's making $5 per share of cash every year. Then I have to figure out what kind of multiple would I like to pay for that. And generally, if I can buy it for 10 times cash, meaning I would get all my money back, if they paid me that $5 every year, in 10 years I get all my money back, and I still own that asset, that right there is a phenomenal investment. And I find those, occasionally, but with the ebbs and flows of the stock market, obviously that price can change. But you find those and you can just sit back and you pretty much collect that, make a 10% return.
So I hear people talking right now, the stock market is really hot. And I know some of you are going to listen to this later when it's not. But, right now the stock market is really hot. And they keep saying, there's no money to be made in stocks. What is your response to that thought? Or how do you respond to that?
Therein lies the falsehood of the stock market. So what is a stock market? If you say it's you judge it by the S&P 500. Again, it's an index fund. But the way that fund is put together is it's got 500 companies, but it's all a weighting system based on your market cap, the total value of your company. Right now, the top 5 companies in the S&P 500, so 1% of the companies make up 20% of the weighting. So if those 5 companies are doing good, you'll see the quote-unquote stock market, the S&P 500, do well. Well, that's where the falsehood is. I look at individual stocks, and if I'm not investing in those 5 and I'm picking other ones, the whole stock market, the S&P 500, can actually drop, and yet I can be making money because I've invested in just a handful of stocks. So I'm not so dependent upon those 5 companies that do well. So people say the stock market's overvalued. Well, if you have an Amazon, which is richly valued right now, but makes up a large weighting in that, yes, I would view them as being overvalued. So therefore, the S&P 500 could be slightly overvalued. But I'm finding stocks that within even the S&P 500 that are undervalued. And so those are the ones I'm going after. So I don't really care what the S&P 500 does. I don't care what the Dow Jones, how it, goes up or down. I don't care. What I'm looking for are the individual securities that I own. And as long as they're doing well, I could care less how the overall index is doing.
So from the sounds of it, are you really saying that there's always opportunity? You just gotta look at it?
Absolutely. That's like saying the housing market is overheated and there is no value in the United States. Well, everybody will know any given day you can find a deal. Or another way to say, oh, you can walk into a grocery store and it's overpriced. I don't know about you, but anytime I walk in a grocery store, there are certain things that are always on sale. Not everything, and actually quite a few things are not on sale, but you'll always find a few items on sale. That's what I'm doing. I'm looking at the individual stocks and always trying to find those stocks that are on sale. And they exist every day.
So in the future, we're gonna get into some of this more complicated stuff. And some of you are sitting here and saying, like, pulling your eyes out. You're like, this is cash flow statements, analyzing. So say somebody like, your 12-year-old self or your, whatever, sitting there saying, I want to try this thing. Maybe they're 30, maybe they're 50, maybe they're 60, maybe they're 12. I want to try this stock thing. How would you advise they get started? And how would you advise they start developing their strategy?
So I have 4 kids, and my oldest one is 11, and I actually have him investing in the stock market. And the way I got him interested and the way I keep him interested is I said, let's look at a few companies. Let's look at some products that you're familiar with. And from there, so for example, I grew up on a farm. So John Deere is pretty prominent. Well, he owns some John Deere stock. And it's not that John Deere is the great stock to own at this moment, but it's an easy business to understand. They make farm equipment. It's got a phenomenal brand, and I will then discuss with him without going into a lot of details. They make profit. They people are not going to stop eating tomorrow, therefore farms will exist forever. And something has, these farm equipment, they wear out. So that's an investment that, you may go, well, am I buying at the right time? I'm buying at the wrong time. I look at it like you can buy those types of investments that you can hold almost forever, with the chances of over time you will make money. Even if you buy high now, in 10 years that might look like a good buy. So I really try to tell people to get started with, pick something you really like. If you like Under Armour clothes, you like your Apple iPhone, you like, and I'm not saying you just buy a stock because of a product, but that to me is a good place to start, because you want to be interested in a product, and that'll keep you interested in trying to learn more about the company. And once you learn more about the company, you may realize they have good products but a bad company, because there are companies that lose money. They don't make anything. Tesla is a good example. They lose billions of dollars. They don't make $1 profit. I love their cars. I think they're amazing cars, but I would not buy their stock just because they're losing money. So I definitely look for that.
Okay, fair enough. Do you remember what your first stock was?
Yes, it was, I lost every penny in it. It was a company called Ion Networks, and I remember watching them in 1999 go from like $2 a share to $34 a share, thinking, if I had real money invested in this, I would be getting rich right now. And so I started buying in around that 34 a share, but that company no longer exists.
What do they do?
That's it. I don't know. I really don't remember. It wasn't about what they did, because at the time I was thinking everybody is trading stocks. They're getting rich with the internet bubble. I just have to pick a company that's hot and throw money at it, and I will get rich.
And it's interesting you bring that up, because I hear people do that all the time. The market's shooting high. They're like, let me dump money in it, or this stock's doing well, let me put money into it. It sounds like you're saying that's not the way to do it.
No, not at all. If you are trying to chase the market, you will get run over. You will lose money. That is not the way to do it. You will find times, especially now, I buy a lot of stocks that the analysts hate, that people are not buying their stock prices are down. And I do that because that's usually where the values are. If everybody is chasing Amazon or chasing some of those big companies, then all of a sudden that pushes up the stock price so high that even buying, even holding long term, you could be down money. I mean, if you bought Cisco at its height in 1999, I believe they're either still down or they're breaking even after almost 20 years.
That's interesting. So I'm sure a lot of people who are just getting started don't really understand how stock prices get their value. And I think this is where Bill's really, really good. It's not that he just, trades and makes money trading, but he actually understands how the markets work and how the whole stock world works, which is where it's really beneficial for these conversations. So can you help explain, how stocks get their value and how they change in value?
So the best way to say this, so a company has revenue. They have costs associated with that revenue. So the revenue is like their sales. And I'm going to try to break it down to the simplest example. Let's say you buy an iPhone from Apple and it's $1,000. That iPhone, that's $1,000 of revenue to Apple. But they probably spent, $600 to make it, market it, and everything else. So you could say the profit from that iPhone is $400. Well, if that $400 gets split among 100 people because there's 100 shares of stock, then everybody, you divide it down, you get down to $4 a share. So that's where you hear this earnings per share. It's really your total profit divided by the number of shares outstanding. When you get to that number, a lot of people start throwing a multiple, and a multiple just means how many times up would you be willing to pay for that? And the general consensus is 15 times. That's just some number that throughout history people say, a stock is fairly valued around 15 times. So if you had a $4 in earnings times 15, you could say roughly $60 is a fair price to pay for that stock. Now, that's not always the case. I mean, the markets are not efficient regardless of what anybody says. So that $60, it may actually be $40. It may be $100. It could be $500. It could be, and that's where you still have to do the individual analysis on it to make sure that you're not overpaying for something. But as a rule of thumb, you try to pay the smallest multiple of earnings, because that'll give you the best chance of if it ever reverts back to that 15 ballpark, where you can make some money. And again, it's all about long term.
But then don't some stocks trade way above that level and some stay way below?
Oh, absolutely. You have stocks that biotech stocks are a great example. Many of them can go, almost 20 years without having $1 revenue or because they're trying to get their drugs approved. And yet some of them might trade for $1 billion, the whole company's worth $1 billion. Well, if you have no revenue or you have no profit, how can you be worth $1 billion? A lot of that comes, are expectations of traders or investment managers going, I'm going to buy this stock because I think they're going to have positive results in 12 months. So you can buy on expectations, but that's a little more dangerous than buying on reality. And I like to look at reality. What is actually happening today? Now, that's not to say that I won't buy on the expectation that something positive is going to happen. I've done that before. If I see, hey, Apple's going to release a new iPhone in 3 months, and knowing the cycle, they think a lot of people are going to replace their phone. Well, that might actually be a good time to buy, because a lot of people are going to buy that phone, so their sales will probably go up. So you can buy on expectations, but most of the time, to really try to make some money or try to do well, you really need to look at the reality of what's going on right now.
And that's interesting because, once again, a lot of people who want to invest in the stock market, they're just like, hey, stock market, here's my money, let's see what happens. But what we keep kind of getting into here, and it seems very clear, is, we got to be careful about that, because the stock market is a big old world, right? It's kind of like your neighborhood or in a city, and there's parts of the city you want to stay away from, and there's parts of the city you want to be in. And, if somebody's moving to your town, you don't necessarily say, yeah, just buy some random house off of eBay or Craigslist, right? You say, hey, go check the house out, check out the neighborhood. Figure out if that's the house you want to live in, if that's the right neighborhood, if that's the right schools. And it sounds like you're kind of saying the same thing about stocks. And so I can imagine there's a lot of different stock strategies out there. You got day traders out there. There's, buy and hold investors. There's speculative investors.
Yes.
How would you classify yourself and why?
I am definitely a buy and hold, and I would go more on the value side of buy and hold. My philosophy on stocks is I'm really buying my future income stream. So, for example, if I can put $1,000 into a stock and it pays a 2% dividend, I'm getting $20 back out of that $1,000. Now that doesn't mean my 1,000 went down to 980. It just means that I am buying a company that's now going to hopefully pay me $20 a year, and hopefully with growth of that dividend. So over time, I will get my money back, still owning the asset, but it's all about income. So if my goal in life is to really invest in stocks, pick the stocks that pay dividends, and look at stocks that can generate an income high enough that I'm not really working for that. I mean, I currently have enough dividend income to be equivalent of a $9.63 an hour job, take home. That's equivalent of about $12 an hour. Well, I'm not working 10 hours a week, 20 hours a week, 40 hours a week for this job, yet I get paid like I am. So that's what I'm doing, is I'm buying my future income, and I'm really trying to replace my current job income with dividend income.
And it's interesting. I've always heard the analogy of like your money being like little soldiers for you.
Yes.
And they can go out there and either go to work for you or go fight for you. And you didn't use that kind of terminology, but it sounds like that's pretty much what you're saying. You're saying that dividend income are workers, and they're generating money for me in addition to my job. That's truly passive, because I know a lot of people chase real estate because of this idea of it being a passive investment, but then they get turned off by the idea that hey, wait, I have to go find renters. I got to go fix this toilet. Hey, I've got to go, replace the siding and replace my roof. Oh, what about capital expenditures? Oh, my return is nowhere near what I thought it was because I have all these expenses. Oh, nobody's in there, so I've got vacancy. But in many ways, while the stocks take a lot of education, it also sounds like you find it a fairly low risk.
I do. I definitely look at it. I mean, unlike real estate, if you buy a house and you rent it out, and after, let's say, a year and a half, you're like, you know what? I don't have time for this house anymore. I'm getting too many calls. I can't find the right tenant. It's just not what I thought it was. Well, now you have to sell that house. Well, that's never a quick, not always a quick, process. Stocks, I can be in and out. I mean, just click of a button. So if I'm into a stock, 18 months later, I go, you know what? I'm not interested in the stock. I don't think it's a good company, or I need money. I need some money now because maybe I see a better investment somewhere else. I can just push a button and that I just sold the stock. So the risk is, you can get in and out easily. That's now you are at the whim of the market. The stocks fluctuate in price, so you hope that you're not down 30% when you need to get out. But I'm also investing for the long term. So as long as I invest for the long term, I can sit back, I can collect all these dividend checks. I can build up a portfolio where now I've checked in my mind all three boxes of I've created income, I have my balance sheet, which is I've collected assets that are paying me to own them, and that is producing positive cash flow because I have no expenses.
So does that mean you primarily just go after dividend stocks, or do you sometimes buy non-dividend stocks?
I will buy non-dividend stocks. I go after value stocks. So if I see a company that is trading at a really low multiple and just it's been beaten down, it may not pay dividend, but it may be positive cash flow. It may just be, nobody's interested in that stock. I will take a good hard look and go, as long as it's still profitable, it's got a future. You don't want something that I'm trying to think of a good example, but if you buy into a business where it just keeps going down, like typewriters, nobody makes typewriters anymore. But if you thought typewriters are a good business, 20 years ago, well, the writing was on the wall that typewriters are going to go away someday. And so you could be making profit at the time, but eventually your profit's going to go to zero. So I just try to buy those companies that again can give me longevity, and it's been working out.
And where do you go to get the information about the companies?
So the internet is the easiest place. You can look up anywhere. Motley Fool is a great place. I really like them. They have a lot of free articles, so you can go out there and start looking. You can go to any company you're interested in. Obviously, it's a public company if you can buy their stock on a public market. They all have websites. Every single one that I found has a website that you can go there and look up their annual report and look up all their earning reports and everything else. So
very good. Okay. All right, so now for some other questions. What was your biggest failure of stock investing?
I would say, like I said in the beginning, that first $10,000, I was trying to be a day trader. I was trying to do what everyone else was doing, which was you get in one day and you get out the next day and you try to make that small, thin margin. And I thought, everybody else is doing it. I hear all these success stories. I'm going to follow them. Being a follower was the worst thing I could have ever done. My success really came, from a failure. It was just that. On the flip side, my success came from buying when others weren't buying. And generally, as long as I try to learn from my mistakes, which again, I tell everyone that my greatest investment was losing the 10,000, because that forced me into trying to learn, and then trying to find companies that were solid and not just trading based off of expectations.
So I too, like him, got hammered early on in my investing efforts. And it's kind of funny because I know so many people who are afraid to get started. And they're afraid to get started because they don't want to lose their money. They're like, I worked hard for that money. I don't want to lose it. But often, because people are so scared of losing that money, they don't get to reap the rewards of investing that money. So, a lot of people will talk about how you might lose some up front, but that's an education. As long as you're learning from it and how it works, you're better off getting in there, losing some money and learning from it than you are being too scared to get involved and just standing back. And so, Bill here, he got hammered in his first investment, and now he's not only super successful in finance, he knows more about investing than I probably ever will. And he is, he's good at it. He's on top of it. He's getting returns that I could only dream of in the stock market, which is unreal. So that brings the other side of the coin. What is the best investment, your biggest win that you've ever had?
So, like I said, I like to buy and hold. And I remember it was January of 2005. I bought this company called Apple Computer. And at the time, they had 3.2% of the computer market. This was before the iPhone, iPad, everything else that they have. And they did have the iPod, but it was a small piece of them for the most part. I was looking at the computer piece and saying, if they are projected to double their share of the computer market, double their share, that should double the price of the stock. And they were hoping to do that within a couple of years. So I bought the stock. And then it started going up. And by 2007, that's when the iPhone came out. And that's when I was, they saw this additional revenue stream. And I held on. And I just kept holding it. And I still own it today. And it is up, 4,000% plus, which has been a great investment in churning out dividends almost the equivalent of my cost basis. So
What's cost basis? Some people might not know.
So cost basis, for example, if you put $1,000 into a stock, that $1,000 is your cost basis. So what would happen is, over time, like I said, if I'm getting back my cost basis, I'm then getting back about $1,000 in dividends a year. Well, that means I've got my money back out of it. I still own the asset. And guess what? Next year, hopefully, they give me a pay raise. They increase their dividend. Now I'm getting more than $1,000. But Apple was by far my best investment. But I've held for a long time. Even through the ups and downs, the 2008 stock market crash, I did not go crazy. I did not sell everything. I held on. I lost like everybody else on paper. But in reality, that was the best thing I could have done was hold on to my investments. Because I technically didn't lose anything then. Because they're all up now.
Yeah, talk about the difference between paper value and cash value.
So let's say you take $1,000 and you buy a stock. Let's say the value of that stock drops and it's now worth $900. Well, if you haven't sold it, only on paper, meaning you haven't realized the loss, only on paper you're down $100. Now, if you actually sold for the $900, you will realize a $100 loss. But if you don't sell, you're not technically, you haven't realized any kind of losses yet. The hope is that 900 then bounces back and it goes up to 1,100, 1,200, 1,300. And then at that point, if you sell, you've realized the gain. So, when I talk about cost basis, it's what you put into the stock. Paper losses are only on paper. You have not realized the loss. You may say, well, my portfolio's down. Well, hold on a little bit longer and tomorrow it might be up. So,
All right. So what is your oddest or weirdest company you ever invested in?
oh man,
You didn't get these in advance.
I don't know. That's a good question. Generally, I only go after, fairly large companies, or at least established brands, and generally those are not small companies. I stay away from, like, all the marijuana companies now, and all the, back in the day, there's all these, as fads kind of come and go. I've stayed away from most of them. I can't really think of anything that I invested in other than maybe some of those first internet stocks that had no revenue at all. Nothing. Not even a product. I couldn't even tell you what they did, to be honest, other than their stock price was going up, which made me think they had to be a good investment, right? So I can't really think of a weird one per se.
So, sure. So one thing I heard you say here is, really that you trust the numbers. You don't watch the stock price, except as that is additional input in your own research. Just because it's trending up or trending down, that doesn't really influence your purchase decision. Is that fair to say?
Oh, absolutely. Just because a stock did something yesterday doesn't mean it's going to do that tomorrow. So looking at a stock chart and seeing, oh, it's dropping, that doesn't mean anything to me. I'm looking at it, where is it today, and where do I think it's going to be tomorrow? And I cannot predict the future, but if they have solid products that are profitable, the company's making money, and it looks like they're not a fad, they're not a pet rock company, so they're going to be around for a while, I will invest in that company regardless of what the stock price has done.
That's a good tip. All right. So I've got two last questions for you.
Sure.
One of them is, as we wrap up, is there anything else you want to tell the audience today that you think that would benefit them?
The biggest thing I would say is learn. Go out there. You can start. You can find lots of articles about how to begin to invest. Pick up one. Find one company, one product that you're interested in, and try to learn as much as you can about that company. You will be surprised of what you might realize that you can learn about them. Look at the numbers, try to understand them. If you know anybody else that is good with numbers or good with finance, or an accountant, or just somebody like that, you can ask them questions about the balance sheet or cash flow. But just start with one company. Don't try to tackle everything. Don't try to research 20 companies at once if you're just starting. You really need to focus on that one company. Find that one product company that you really like, that you can invest in, that's going to give you good returns, and stop right there. Don't just go crazy right away, because you'll end up in a bad position. I think if you can start small, you can end up big.
All right. So this brings us to the last question, right? The last question that I have to ask everybody. And that is, have you had a chance to join the Millionaire Club yet?
So, as I've said, I lost the first 10,000 I put in, and by the age of 25, I said, that's it. I need to get more serious. My net wealth was zero. I had a house, but I had a mortgage. I had no debt, other debt really, but I didn't have any assets. And I said, I didn't have a 401k. I just didn't have anything. And I said, I need to get serious. I need to make a plan. So I set this goal at 25 that by the time I was 30, I wanted to have $100,000 saved up of net wealth. By the time I was 35, I said I want to have $500,000. And by the time I'm 40, I want to have $1 million. Now this is kind of lofty goals here, going from 0 to 100,000, 100,000 to 500, and then doubling that to $1 million. That's pretty stout goals. Well, I can say at 30, I hit my goal. I had just above 100,000. By 35, I got a little bit behind. But and by 40, I was not at the million. But I'm over 40, and I can honestly say that I have hit that point.
Excellent. So that's what you're hearing now. So there's different ways to make money. Some people think the stock market is all I get is 4% returns, 5% returns. But we're hearing it right here. No, you can. That is a way you can grow wealth. And a lot of people invest in multiple things. I've got some money in the stock market, but I have other money in businesses, other money in royalties, money in different places. But here we're hearing from somebody about how you can really use the stock market to your benefit. The important thing he's talking about is, don't try to get that quick win that's high risk. It's too easy to make money to risk everything in a super high risk game, right? So there's a lot of money to be made that's not high risk. So Bill Kaufman has agreed to post up some other videos on here, some training stuff that we're going to see moving forward. We'll try to get some articles or something like that as well, because he's got a lot of information that can help you become better, finance people, better at your investing, better at your trading. So there's a lot we can learn from him, and so we look forward to having him join us again. So thanks a lot for joining us today, Bill.
You're welcome. It's been fun.
All right. Now, hopefully you learned something today, so go out there and make the impossible happen.
Learn more at MillionaireWho.com.
It's the morning drive.
Just a test of the broadcasting, blah, blah, blah. Don't you like it? Cool.